Hello friends, gold is in the news again and it's already hit 100,000 rupees per 10 grams on the multi-commodity exchange before retreating a bit. Now, what is the future outlook for gold? Is this a Veblen effect or is the rally sustainable? I'm Vijay Bhambwani and I've been trading these markets for 39 years, and through my videos, I'm trying to help newbie traders to make sense and sensibility out of the market data. I do not provide any kind of mentoring, advisory, money management services at all. This is a free channel and it will remain so. And a reminder, you can view my videos with audio in the language of your choice. And here is how on your screen you can click on the geared wheel, click on the audio and choose the language, and hey, you're all set to go. So, coming back to gold, is it the Veblen effect? Now, what is the Veblen effect? So, Thorstein Veblen, who came up with the Veblen effect, said the price of something tends to go up after the price of something goes up. So, luxury items. If you've gone to a mall, you'll see that jeans called Diesel or Rock Revival sell for 10, 15, 20, 30, 40,000 rupees per pair. Why are they so expensive? Because they are premium brand. This is how they are positioned. And why are people buying these jeans? Because they are perceived to be premium. All right, this is the Veblen effect. Is gold going up because people are rushing in and saying, look, it's already hit 1 lakh rupees. If we don't buy now, we will have to buy at 1,50,000 rupees. Or are there justifications for this rally? I belong to that school of thought which feels it is justified. So I will share my point of view in this video with you. As always, my work is always data supported, and I share a lot of corroborative weight of evidence with my viewers. In the description below this video and in the pinned comment below this video, please do refer to hyperlinks of all other videos, articles and supporting evidence that I want you to check out for your understanding of this particular topic and the market on the whole. Friends, in my past videos, as early as last year, I made a strong case for why you should be buying gold in physical format, and even gave you in these videos leads to how to test your gold for purity, how to get it at down-to-earth prices, how not to get conned, how to bargain and get a buyback arrangement in place with the wholesaler. Do go through these videos again and refresh yourself if you haven't seen them already. This would be a good starting point. Also, I gave you some targets in this video. Now, these targets have been exceeded by a very large margin. Do you think that the rally is going to be as strong and as rapid as it is in the past? I will also delve into that aspect of the market. For those of you who've asked me for a video on silver, it is in the works. I will be making a video on silver separately. Please do stand by for that. So I told you that I believe that there is still juice left in this fruit called gold, and you should not be unduly perturbed by calls of intermediate or long-term top being reached in the price of gold every time gold falls by 1, 2 or 3%. By people who want to basically have boasting rights of I told you so when gold topped out. So every time gold falls, I'm seeing a lot of this kind of views being thrown about recklessly in social media. I write a weekly column in Live Mint, and this is India's first and only media column which shares statistical data-based inputs with its readers. If you read my column going back in time up to a year ago or even longer, you will see every week I have been advocating that declines in gold are buy opportunity. And if you look beyond calendar year 2025, the story, the bullish story in bullion, both gold and silver, is still intact. Now, it's time to get into the nitty-gritties. Why is the party still on? Why the punch bowl is not even half empty, which means there is good enough price appreciation left even from here. Although the low hanging fruit is gone, but the rally, even though slower, will still protect you. Now, since 9/11, which is 11th of September 2001, since those twin towers were rammed into by two rogue aircraft commanded by terrorists, central bankers have got used to the idea of taking shortcuts every time there have been an economic slowdown. Now, they've debauched the coupon rate, which is the interest rate on fixed income securities, and debauched the currency by default and by extension. Because when the coupon rates come down, cash carry trade unravels and there is a flight outward of capital and the local currency falls. So, world over, central bankers starting from 9/11, then the 2003 slowdown, and then 2008 global financial crisis, quantitative easing, call it what you want, bond buyback, toxic asset repurchase program, quantitative easing, injecting liquidity into the financial markets, call it by whatever name you want. It is nothing and nothing but printing tons and tons of unbacked currency and flooding it into the market, throwing it at the stock market, the banking and financial markets, and telling them, look, all is well, so don't panic. Now, this has unfortunately resulted in long-term sticky inflation in the global economy. Now, this has pissed off the check writers. Now, here are the large, big ticket investors who invest money for fixed income because they don't keep all their money in the stock market. They diversify into fixed income, into real estate, into alternate assets, etc. I'm going to cover that in this video up ahead. And these guys, the check writers, are extremely upset. Inflation adjusted interest rates have either been abysmal or neutral, and in many cases even negative. And therefore, these guys have basically diversified somewhat into equities, yes, but they are now going in for gold. And there is weight of evidence in the links below this video. Now, what happens when interest rates are cut and the currency weakens? There is a seesaw effect in the gold versus the currency market. Now, let me explain to you what the seesaw effect is. Remember, as a child, we used to go to the garden and play on the seesaw. Two kids sitting facing each other. The heavier kid would make the seesaw go down towards his side, and the lighter kid would be raised higher. So now, this is the seesaw. The currency is becoming weaker, which means it's losing weight, it's getting lighter, and the price of gold is going up because more paper currency is needed to buy the same quantity of gold. So when gold becomes heavier, this side is gold, it's become heavier, currencies become weaker. The seesaw tells you that here, currency devalues, gold appreciates, become heavier. This is why, as long as you have debauchment and a deflation of the value, the purchasing power parity of the fiat currency, gold prices are continuing to go higher. Now, what's a good way to monitor inflation? With those of you who followed my work long enough on social media and in the print media, especially since the last 20-25 years, will remember I used to post the prices of 16 vegetables, a couple of fruits, milk, meats, eggs, etc. And I used to basically tell you that if prices of 90% of these items put together, if they are rising for 4 consecutive weeks in a row, the inflation is going to drag the Indian rupee down and therefore lift the price of gold higher. Now, the reason why I tell you to go to the street level and the vegetable market or the fruit market or the grain market yourself and not get bogged down by numbers that are thrown about in the media is because of a very simple reason. You and me as retail consumers are going to buy from the marketplace, and therefore that is where you should take your prices from. The prices, the CPI or the Consumer Price Inflation Index, which is mentioned in press releases, may not actually be the price present in your locality. So be concerned with what is available in the real world at the street level. Now, there are some of you who might ask, Vijay, if the price of money, the cost of money, remember, I've shared with you three free online books of Dick's Token that you can read, and that is a gold standard on cost of funds or interest rates and their impact on asset prices. So you would ask me, Vijay, what is the headline coupon rate, which means the announced coupon rate by central bankers is going down, and therefore inflation is basically likely to go up. But if price of oil and gas are also coming down, why should inflation go up and why should gold prices not fall? Hey, your argument, your concern, and your debate point is valid. But there is a twist here. Something changed 5 years ago. Now, like I mentioned, after 9/11, central bankers took a shortcut and started getting into overdrive, cutting interest rates and printing unbacked currency. Do you know that of 1 out of 3, if not 4 US dollars floating in the global financial markets was printed after COVID lockdowns came in March 2020? Did you know that? That is the extent of rampant currency printing that global central bankers have resorted to. Now, if equity markets are going to come down, even because of profit taking or whatever reason, where do you think this extra money sloshing around the place is going to go? It's got to be deployed. It can't be basically decommissioned in a hurry. So my guess is going into gold. I have written an article on money control where I write a weekly column as to why equity bulls should not celebrate just because the price of oil and gas go down. The hyperlink to that article is in the pinned comment below and in the description below. Now, the sum and substance is that this time around there's excess liquidity. And some of you have even gone to the extent of asking me, Vijay, what about the dollar milkshake theory? Well, very simply put, I don't subscribe to it. I don't believe it to be a fact. And it seems to be more of jargonized wisdom coming out of people who probably may not even be trading the markets. Why does that happen? Do you remember Mr. Amitabh Bachchan's super hit movie Amar Akbar Anthony? Do you remember the song where Amitabh Bachchan comes out of an Easter egg and says, "My name is Anthony Gonzalez"? Part of the song goes like, "By the hemoglobin of the atmospheric pressure in the country." Is there something called the hemoglobin of the atmospheric pressure in the country? It's a figment of imagination. Why was it said? Because the girls go, "Wow!" It sounds complicated, it sounds intelligent, said in English, said fast and rapidly and confidently. It gives you an air of being clever and intelligent. This is what many of the theories floating around in the public domain actually are. No offense meant to anyone, but we as traders need to be careful about what we believe in. So the dollar milkshake theory says that the central bank in America, the Federal Reserve, can continue to print as many dollars as they feel like, as long as the Senate keeps raising the US debt ceiling. Because printing a dollar is taking debt from the public. Remember, every currency note says, "I promise to pay the bearer." So it's an IOU, it's a debt. So as long as the ceiling is raised and the dollar is continuously being printed, whenever good times come, when the crisis in the market is over, just like you sip milkshake from a thick straw, the US Fed will be able to suck out excess liquidity from the market by buying back these dollars or destroying these dollars back. I have yet to come across anything more bizarre than the dollar milkshake theory. If you were to suddenly withdraw liquidity from the markets will go into anaphylactic liquidity shock. You will see asset prices plunge like never before. They will come down like an aircraft whose engines were switched off. The force of gravity itself, combined with short selling by bears, will hammer prices of assets faster than you can imagine. Remember what George C. Lane, the father of the stochastics oscillators, said. In a bull market, prices go up the staircase, but a bear market is dirty. It's like diarrhea, quick and dirty, falls down the elevator shaft. So, I don't think I would believe the dollar milkshake theory. You can't just keep printing money and then withdrawing it at will and say, look, the market is not going to feel impacted at all. So, the more nervous you make the market about this front, the more gold prices are likely to be bullish. Why did I say headline coupon rates? Because real effective coupon rates are different. I will cover that in the later segment in this video. Friends, in my recent video, the last one that I made, this is the thumbnail of that video. The hyperlink is provided in this video below. I told you that pension changes in the European Union and the USA are somewhat keeping me awake at night. It's not just about the changes from defined benefits to defined contribution plan. It's also about President Donald Trump bulldozing executive order to take Plan 401k, which is the US retirement money, and investing it in private debt and private ventures. Now, pension funds are very simply the biggest investors in global equity markets. Why? Because you and me, if we take up a job, are going to contribute to this pension fund and get this money back only after we retire, when we reach retirement age. It is 58, 60, 65, depending on which nation we are talking about. So this is long-term money lying with the pension fund, and since the pension fund looks at a bigger view, they buy equities with a very, very long-term outlook. If these guys are going to get less and less money because there are pension changes in the US and in the European Union, imagine what happens to equity prices a couple of quarters down the line. Which is why stock markets last week were nervous. Of course, there were other reasons, trade deals with other countries, etc., etc. But pension funds, for those who know, savvy traders who understand the markets will tell you that this is the big thing. Now, if equity prices are going to get turbulent, give you either poor returns, flat returns, or even negative returns, do you think this money will not get redeployed elsewhere? Do you think money will not move out of assets that are not giving a profit into assets that are likely to give a profit, which is gold? Here you have another bullish point for gold. I hope you are being told about this from whichever source you are depending on for your trading and investment inputs. Well, some of you have told me that I have an offbeat approach to approaching the financial markets. Guilty as charged. Number one, I don't depend only on technicals, fundamentals, statistical or screen reading or domain knowledge of the industry that I'm trading. I take a medley of everything. It's called a 360-degree worldview of the markets. So no one factor can determine whether I should buy or sell anything as a standalone indicator. Secondly, I am a proud Sindhi. Now, we as Sindhis are approximately 25 lakh, 2.5 million people in this country. We have a very different approach towards money, finance, wealth, and the way we hand down wisdom about the same through the ages. We, of course, encourage our children, just as I was encouraged when I was a kid, to go to college, to learn all you can about trade, finance, business, enterprise, endeavors, free markets, capitalism, etc., etc. But it's more to know what the contemporaries are thinking like. Because this textbook knowledge is something that everybody knows, and what everybody knows can hardly be ever too effective. We encourage our children that if once you've absorbed all the theoretical and academic knowledge that you want to, go to a rich uncle, fall at his feet, and learn from him how business is actually done. Because he's not just theoretically knowledgeable about it, but he has done it, been there, seen it, and done it all. He can teach you, or she can teach you, how to actually get the job done, which means two things. Number one, we follow the money trail. Number two, we believe in doing things rather than theorizing it. Now, why am I telling you this? This is not a boasting point. This is a trading game plan by itself. If you want to follow the money trail and if you want to see where the big money is going, can you really ignore the world's largest auction houses to see where the rich are putting their money? I don't think so. Ignore this at your own peril. Just see how the prices of works of art, vintage cars, antiques, wine collections, memorabilia of royalty from another era, just see how the standard or the base prices of these goods are rising quarter on quarter at these auction houses. Why? Are prices high just because the auction house is saying, okay, we are feeling bored today, so why don't we just raise the price of everything by 50% and see what happens? Let's have some excitement. That's not the way things work. They are rising because rich money and big money, and remember, it is the big money that moves the needles and gauges in the market. I'm not saying anything to the detriment of a retail investor, but I'm sorry, it is the high net worth and the ultra high net worth individuals whose money moves the prices. All right. So these guys are actually salting away money from the stock market, where of course they are still invested, but they are also putting it into alternate assets, wine collections, art, gold, silver, and this money is increasingly showing signs of being diversified to the detriment of equities and inflows into bullion. So here you are, the money trail of the big ticket doers of deeds tells you that you should be following the money. Have you noticed how central bankers all over the world are on a gold buying spree? I have basically provided you hyperlinks at the bottom of this video and in the pinned comment below on media articles about how much gold is being purchased by central bankers of various nations. And they are in thousands. Yes, thousands of tons, not kilos, thousands of tons. Now that is the kind of absorption of supply of gold that is happening worldwide. These are big ticket purchases and they will definitely impact the price of gold. So if at all you do not have a rich uncle whose enterprise you can go and learn this trade from, what about the richest uncle of them all? In the case of India, Reserve Bank of India. Reserve Bank of India is our richest uncle, and he, for the want of a better suffix, is not secretive. Go to rbi.gov.in, RBI Government of India. Go to rbi.gov.in, spend some time in analyzing the data that the RBI is good enough to share with Indian citizens, and you will notice how much of gold reserve that they have, what is the inflation outlook, what the economic outlook is, what the economic survey that they conduct multiple times a year tells you about the business environment. Instead of wasting time on social media and watching reels and whatnot and cracking jokes about it, do spend your time here, because we traders and investors are brain warriors. We win with our ideas. As long as our ideas are more meaningful and more relevant than other traders, we will be able to take their money and put it into our own pockets. So follow the money trail by watching the RBI. Have you noticed how the world is suddenly a whole lot more nervous, whether it is pay cuts, whether it is job cuts, whether it is threat from artificial intelligence, robotics, whether it is climate worry, whether it is geopolitical concerns, whether it is inflation, or is just about slowing down of the global economies, which is taking away peace and lending you a whole lot more nervous tension. That nervousness is basically bound to trickle down to human behavior if you are a believer in behavioral finance. Now, whenever there is a kind of a lull in confidence levels, people tend to go to gold as a last resort. Why? Because for 3000 years, mankind has depended on gold to be a store of value as well as a source of capital appreciation. It has stood the test of time, and therefore, I believe that gold will continue to rise as long as there is an overhang of nervousness in the air. Now, friends, I come to the global aspect of how governments are taking away the peace of their citizens. My Indian viewers, take particular note. This is more about Europe and US before you comment on this video. Now, in this video, I mentioned how the pension plans are likely to basically give hardship to a working class guy in Europe and US. In addition to that, history is not really very cheerful about what governments can do when push comes to shove. Do you remember or have you read about how the US basically confiscated gold from its citizens after the 1929 Great Recession occurred, and they basically put a cap on number of ounces of silver an average citizen could own, and beyond that the government had the power to basically confiscate it, and silver could not be used as currency in the 1930s after this executive order. Have you forgotten the Cyprus banking crisis? Please Google search it. In 2012-2013, Cyprus confiscated money of its citizens from their bank accounts for repaying external debt. Have you forgotten the bailout of Spanish banks? Spain, one of the largest 4 or 5 economies in Europe. Not very late, it is 2012. Have you forgotten your history? How, in order to bail out the banks, people who were owning the preference share of these banks, which is a quasi debt owed by these banks, were told to take a haircut so that bankers could come back into making profits from the severe losses that they had suffered in the global financial market crisis of 2008. I'm talking of 2012, 2013, not of the previous century. You do not have an excuse of not knowing your history. When citizens are nervous about such events occurring again because the governments are being pushed into a corner, they might just take away the citizens' money. Panic buying will occur in gold and silver. Remember, I'm telling you this is Europe and America. Before you comment, be careful about that. So like I said, we basically traders are brain warriors. We fight and win with our ideas. It pays to have meaningful conversations with doers of deeds rather than whiling away our time on social media. So very recently, and this is about behavioral science, I want to share something with you. Very recently, I put up something on my Telegram channel, which is a one-stop shop where I put all my reports, all my thoughts, because as a platform, there is no limitation on what file attachments I can upload there. PDFs, zip files, picture files, videos, everything goes. All right. So I had put up an article of Economic Times, which had appeared in the media a couple of days ago, about how out of 275 mutual funds covered by this study, 123 mutual funds had been loss-making, which means their NAVs were lower over a 9-month period which this study covered. The remaining were profitable, but just about. 2 were no profit, no loss, which means their NAVs were where they were 9 months ago, which is actually a loss, because if you've read Dick Stoken's books, you know that money has a cost, and cost of funds is something that you need to basically take into account. Guess what? I received negative feedback. Said, how can you say this? How can you put this up on social media? My fund is doing so well. Or some other guy said, you might trigger some more worries into people. Why should I be listening to this? This is negative. This is causing me stress. So people, I have realized, do not really want to face the truth. And what happens when they ultimately face the truth? They swing from one extreme to the other. This extreme, that absolute a euphoria about equities when it's basically tempered down, will swing to the other end of the pendulum in an emotional overdrive and get into gold. Now, when these guys come into gold, you know gold will hit a top. Unless that happens, I think gold still has a long, long way to go. Behavioral finance and behavioral technical analysis can often provide you keys where other analysis fails. Now, earlier I promised you I would differentiate between headline coupon rates and the real effective coupon rates. I have been telling you on my Telegram channel that the real effective cost of money is up. Why? The bank might be reducing the coupon rates, but who is it for? It is for you and me. When we put in a fixed deposit there, we are getting lower interest. Go there as a borrower. Are you able to borrow money at the coupon rate that is announced in the newspapers? No, you're not. You're not going to be able to raise the money. So, cost of money for the borrower is higher. Corporate India's borrowing cost is likely to go up from here. If they want to borrow serious money, they will have to pay a higher coupon because check writers are demanding and getting a higher coupon rate, which means corporate profitability is not going to be very great. And the profitability of BSE 500 companies, which I covered in that video of pension funds, has already given us an inkling. If profitability of corporates is falling, if stock prices also follow suit, where do you think that money is headed? Gold. We are going to gold. Now, friends, another point. Geopolitics. Where do you think the world is headed? Is there going to be more peace or is there going to be more tension? There are no prizes for guessing answers to this one. Now, wars are inflationary, disruptive, and scary. All are bullish factors for gold. After 9/11, US clamped down on free flow of money across the borders online and into numbered faceless and nameless accounts. Europe also followed suit. What you are doing nowadays, giving FATCA declarations, etc., when you buy mutual funds, is all after 9/11. This is to track money and to ensure that no money laundering or terror financing, etc., is taking place. All positive, of course. But did it halt terrorism? Did it make a dent in the sex trade or in the narcotics trade? No. Why? Because these three illicit trade mechanisms simply switched the way they made payments. At that point in time, it was gold. Shortly thereafter, they also adopted crypto. Ask yourself one very simple question. Has the price of gold and crypto risen in the last 10, 15, 20 years or fallen? And has the purchasing power of the official currency risen or fallen in the last 10, 15, 20 years? What am I trying to do here? I'm basically trying to tell you that the legitimate law enforcement part of the economy that is funded by fiat currency is getting poorer. The illicit trade which uses crypto and gold as its currency is becoming richer. So is the law enforcer more capable of enforcing and protecting the citizens, or is the law breaker more richer and more capable of causing stress in the world? There are no prizes for guessing this. And if the law breakers are more capable of creating trouble in the world, is it positive or negative for gold? You be the judge. Alpha into omega or omega into alpha. It's a choice ultimately you have to make. Now the monetary system in the world itself is changing. Led by Eastern European countries, Russia, Poland, etc., and Asian countries, China, Korea, India, the central bankers are on a spree to buy gold. Europe and America is going slow. They are yet to catch up. What happens then? There is going to be a disruption in the currency exchange mechanism between East Europe and Asia on one hand, and Western Europe and America on the other. There is likelihood to be a disruption, and disruptions are always a very volatile event when people tend to resort to flight to safety. Safe haven buying. What comes to your mind when you say safe haven buying? To me, it's gold. If at all, BRICS was to come out with its own common currency, and they made it very, very clear is going to be gold backed currency to imbibe confidence into people that the Bretton Woods institutions of fiat currencies unbacked by gold is not something we want. What do you think is going to happen? There will be a flurry of panic buying in gold somewhere down the line, which is again something you should keep in mind. Will the rally in gold be smooth from here? Far from it. I'm not saying that at all. Only the naive will believe that gold is on a one-way ticket to the moon. I expect lots of volatility because short-term traders will be getting off this bus. Short sellers might attempt to short the market. There will always be a wisdom coming in from people who would say, look, an intermediate top or a long-term top has been reached, and therefore they'll basically encourage people to sell. Profit taking itself might just cap the rally and cause a little bit of a decline. All that is routine. Like I said in my media column, look beyond calendar 2025. I maintain that view. Do remember which phase of the market we are in. Like I've been telling you since end of 2023, 2025 is the year of pro-cyclical hysteresis. Now, as I have also told you in these videos, what you should expect in terms of price behavior, how the market will tell you which phase of pro-cyclicality is going on. On my Telegram channel, I have also told you the phases that will follow when pro-cyclicality occurs. The phalanx will come first, the pincer the next. Third will be volatility in the currency market, and then bond yield convexity will occur in the sovereign debt market. All are going on track, on time, as expected, which tells me that the hypothesis which leads up to these, after these four factors is that gold has to go up from here. Should be a high probability event. Friends, how much of your capital allocation should be in favor of gold? Now, that's a very personal question. Now, as far as I'm concerned, I will tell you what I said based on what I believed in a YouTube interview to a YouTube channel about a year ago. I said you should be allocating 25, if not 30% of your entire capital to gold and silver. Now, I could sense a sense of disbelief and even amazement amongst the other participants, but there is nothing, and remember, I base my decisions on statistical data and numerical data. There is nothing which forces me to think that that hypothesis of allocating 25 to 30% of your capital to gold has changed in any circumstances. Nothing has changed at all. Now, I have a few American friends, especially on the East Coast, who say, in God we trust. I'd like to modify that just a little bit. I would say, in God and gold we trust. So this is what I have to share with you about gold. I promise you I will be making another video on silver as well. Friends, before I sign out of this video, I would love to know what you think about my work in the comment segment. Do let me know what my videos are helping you do and grapple the markets better. I would also appreciate it if you share my videos with your friends and family and help me spread the cult of knowledge-based investments and trading. If you haven't already subscribed to my YouTube channel, please do, and click on the bell icon to receive instant alerts about fresh videos being put about here. I thank you for your patience in being with me in this long video. Till we meet in my next, this is Vijay Bhambwani signing off for now. Have a very, very profitable day ahead. Take care. Bye-bye.